Traditional finance requires us to rely entirely on intermediaries. Banks sit between our transactions, dictating the speed of international transfers, adjusting the money supply in ways that inflate away purchasing power, and ultimately demanding our blind trust to safeguard our own assets. In 2008, a pseudonym named Satoshi Nakamoto published a white paper outlining an alternative, a peer-to-peer electronic cash system. It proposed a mathematical framework that would allow individuals to transact digitally without requiring a trusted third party to verify the exchange. By January 2009, the Bitcoin network officially launched with the mining of the Genesis block. This established the first working decentralized architecture for digital money. What began as a cypherpunk experiment has since rapidly scaled. Today, thousands of blockchain networks host a highly liquid, relentlessly volatile, and fully global financial market. Surviving and profiting in this environment requires two distinct skill sets: grasping the underlying computational physics of how the network operates and executing the strict tactical rules of how the asset actually trades. A traditional system relies on a central server. Blockchain uses a distributed digital ledger where independent nodes simultaneously maintain identical transaction histories. To secure this data, nodes form a linear chain. Each block of transactions is chronologically linked using a unique cryptographic hash. Before a new block can be attached to that chain, distributed participants have to agree it's valid. In a proof-of-work consensus system, network miners expend electricity to solve intense computational puzzles to validate it. Because every block directly references the cryptographic hash of the previous one, attempting to alter a past transaction requires recalculating the math for every block that follows. The architecture engineers a system of trust through pure mathematics, removing the need for a central authority entirely. Bitcoin established a secure, decentralized store of value. Ethereum expanded that infrastructure by introducing programmability directly onto the blockchain itself. This flowchart illustrates a smart contract. Instead of hiring an escrow agent, a developer writes self-executing code that automatically releases an asset the exact moment a predefined condition is met. Removing intermediaries at the code level allowed developers to build new utilities. They created custom tokens, established decentralized finance lending protocols, and formed autonomous organizations, governed by community voting rather than corporate boards. Cryptocurrency grew from a singular digital currency into a comprehensive, automated, and borderless financial web. Operating in this space requires strict self-custody. A public key functions like an account number, but the private key that authorizes transactions must remain entirely secret. Whoever controls that specific alphanumeric string controls the assets. If you lose that key or authorize a malicious smart contract, the funds are gone. The transactions are mathematically irreversible, and the assets themselves routinely experience severe double-digit price swings. The network architecture is highly secure against systemic corruption, but because there are no central authorities to reverse errors and no institutional safety nets, the user assumes 100% of the financial risk. Navigating a market that never closes requires an objective framework. Rather than relying on lagging indicators that calculate past averages, traders use price action to analyze the raw, real-time decisions of buyers and sellers. Look at this multi-tiered chart. Traders identify structure across different timeframes simultaneously. The daily chart shows a clear macro uptrend with higher highs and higher lows, providing the context needed to trade a micro pullback on the 15-minute chart. To map the entry points, traders draw horizontal lines across previous swing highs, swing lows, and obvious liquidity pools. These mark the exact zones of support and resistance, where price is highly likely to react. From there, the strict rule is patience. You do not chase green candles moving aggressively upward. You wait for the price to fall back to your predefined support zones before considering an entry. Analyzing raw market structure provides a logical, objective map to navigate an otherwise chaotic and emotionally driven environment. Reaching a support line is just the first step. You need confirmation. Traders watch for specific shapes, like this bullish engulfing pattern, to form precisely at the zone, verifying that buyers have actually stepped back in to defend the level. The setup sequence is rigid. Identify the higher timeframe uptrend. Wait for a pullback down to structural support and enter the trade only after a candlestick pattern confirms the momentum is shifting back in your favor. Every entry requires an immediate exit plan. A hard stop loss is placed directly below the recent swing low to cut the trade automatically if the structure fails. A profit target is set at the previous high. By risking a maximum of 1% of their total capital on any single setup, a trader can sustain a streak of multiple losses without severely damaging their portfolio. Maintaining a strict 1-to-2 risk-to-reward ratio means you can lose more than half of your trades and still turn a consistent profit over time. The underlying technology of cryptocurrency removes the need to trust banks, but successfully extracting value from it requires you to ruthlessly manage the risk of trusting your own emotions.